that. And this is today's event. We are going to talk about the market, Fed policy, recent rate cut, plus the forward guidance, and the election. What's going on? I'll bring up the question again: who is more powerful, the president of the United States or the Fed chair? That's another one of those wise questions, or the wise answers. We'll see. And a couple of words about Frances. She's also does some great work with the United Nations, and I don't know if you want to talk a little bit about that at some point. You're welcome to. Well, I'll let you turn the floor. Do you want to say a couple of words about what you're doing today? Let's start here.
Well, today we're talking about the Fed. It's one of my favorite topics, and you know, it's usually not. It's kind of a dry topic, and I was just thinking they should hire comedians to give legal disclaimers so that people just don't fall asleep during those things. But they are necessary, of course. The Fed is a very necessary component to any investing, and you know, it's just I try to discuss these things in a way that's meaningful, but also, you know, understandable, applicable to, you know, the various things that people are looking at. My work with I'm on a UN committee. I'm the chairwoman, and actually I have a co-chair, John D'Agostino, of the Global Digital Finance Committee. And what we are looking to do is talk to governments about their fiscal situations, their liquidity relative to their debt, and also the integration of, you know, digital finance in a multitude of capacities, but also looking at, you know, countries like El Salvador who've made Bitcoin a legal tender, and what the implications are for that, whether or not it would be widely adoptable or not, and under what circumstances. Bitcoin cannot disrupt or replace the central banks, just mechanically it doesn't work. And so how would you, you know, move forward other than having a central bank digital currency? And so that's my role at the UN. I'm also an economic strategist and wealth manager with a firm. We'll send you more information about that. And basically my area of specialty and expertise and passion is the global macro economics, because that really has a trickle-down effect to everything in the economy. And there are a multitude of seasons to investing, and sometimes your bottom-up, quote-unquote, bottom-up stock picking is relevant in certain seasons, and then sometimes the you know, top-down effect of the global macro dynamics with both growth, inflation, and, you know, various policies in the United States with the Fed, fiscal policies with Congress and the president, and also just globally with central banks. So those things kind of affect every investment and should be considered in the face of any investment. And so it's nice to have somebody who's able to, you know, think very clearly about that larger picture, because you can invest in, you know, some of us, you know, we have a passion for real estate, or we have a passion for commodities, or we have a passion for stocks, whatever it is. But those stocks, and particularly certain sectors, perform very differently in, quote unquote, the 4 seasons of investing. The 4 seasons of investing are determined by those growth, inflation, and policy dynamics. And that's what I'm here to shed light on today for you guys.
Thank you, Frances. I appreciate your brilliance, and you're absolutely right. All folks need to have a great diversification play, and market cycles make a big difference in their decisions. But at the end of the day, building a portfolio for long term with prudent diversification is sort of the goal of many folks.
Yeah, right. And just quickly, I just want to say you can sometimes diversify within an asset class, like, you know, commercial real estate, depending on the various underwriting procedures and various levels of debt. I know we're going to get into that a little bit later. Or, you know, whether you do debt or equity, you know, where you are in the capital stack, that kind of thing. You can do diversification within an asset class, or you can use other asset classes to diversify. Yeah,
I appreciate that wisdom. So let's talk about yield curve. So this is one of the graphs you provided, and the little bit of excuse you were upfront that some of these graphs, the quality could be better. But I think that this still conveys the message. Would you be so kind as to talk a little bit about what you would like to discuss on the yield curve?
Yeah, so this is basically the yield curve. I believe it's 10s and 2s. This is provided by Game of Trades, and then the internal data is fed into it by Bloomberg. And what this is basically showing, those gray bars are recessions. And what's interesting about the yield curve is it was, it's been inverted for quite some time. And for those of you who don't know what that means, it means that you are getting paid more on short-term debt than you are on long-term debt. That doesn't make sense, because you would think that you would get a higher yield for tying up your money for more time, right? And so anytime in the laws of physics, the laws of nature, when you have something that is unnatural, you're going to have a related domino effect. And as you can see, when that line is moving down, that's inversion. And as you can see in those highlighted black lines where they're a little bit thicker, which precede each of those recessions, that's the re-steepening. And what this shows is there's a saying out there that yield curve inversion, portends recessions. And that's so true. But it's actually that historically based on this, that the recession shows up during the re-steepening phase. And that's what we have going on right now, is we have a re-steepening phase. And so the other thing that this chart shows is that there is a catalyst. Okay, so here you have a domino effect mechanically within the system, but there's a catalyst that ticks that first domino. So you can have those dominoes perfectly laid out for a recession, but you've got to tick over the first domino. And it shows in the 90s, that was the invasion of Kuwait. In the early aughts, it was the tech bubble burst. And then, of course, during the global financial crisis, it was the housing bubble burst that set off that first domino. So right now, we haven't yet, though there are lots of candidates for catalysts for this, we haven't yet seen what the catalyst is going to be to play out the mathematics embedded in the inversion and then re-steepening of the yield curve.
So what could be a catalyst? So given what you just described, that there has to be a catalyst, the reinversion of a yield curve is a likely predictor that we enter in recession, but it's not a guarantee. So I'm going to ask, is the war with Hamas, with Hezbollah, with now Iran possibility of really destabilizing the market? Oil shocks already seems to be happening, that the oil is responding in a nervous manner, that there can be a significant oil shock if the war escalates. Is that a possibility? What else could be a significant catalyst for a real recession?
Well, the thing is geopolitical risks, right? So we will lump those into geopolitical risks, as you say, start having traders, investors, and governments even investing in characteristically alongside that risk. So for instance, if you have the price of oil moving up, then that domino effect is that usually increases inflation. And the price of oil, probably goes into the CPI. They all have lags, but I think the price of oil and the price of gas have a 1 to 2 month lag before they show up in CPI numbers. So what's happening is you're putting input into the data of the system, and that input, as it flows through with these long and variable lags that the Fed likes to refer to, may not show up for a minute. It's like you have a few cancer cells, you get early cancer. That's, even though you quote unquote have cancer in your body, that's maybe not going to manifest into the various stages of cancer for quite some time. And so the geopolitical risks, yes, if we have the start of World War III, which some people online are suggesting is imminent, yes, that's going to have that could be a catalyst. The election could be a catalyst. You have on the one side, you have Trump, they want to drastically cut fiscal spending and they want to drastically cut regulations. Well, fiscal spending has been kind of keeping the economy liquid, even though the Fed has been removing liquidity from the system. And so you'd have to adjust that very carefully, or make sure that you replace that liquidity in some other way, or taper it very responsibly. Otherwise, you're going to get a massive austerity effect in the system. And if the Harris and Walz administration goes into office, I would imagine that spending and huge deficits are going to remain quite high. Well, what could the catalyst be under that scenario? It could be the fact that the U.S. is facing a question around the viability of the US dollar as the world's reserve currency. And the fact is, and Elon Musk has stated this in his, I listened to the All In podcast that he did. And it's just like, look, this country without the world's reserve currency is headed toward bankruptcy. And it looks like a third world balance sheet. So how are the two administrations going to treat that? Could be a catalyst. The more quintessential catalysts of these things are credit events. You have the 60% of the populace is living paycheck to paycheck and putting their bare necessities on credit cards, start defaulting, and those defaults have inflected, but they haven't been increasing. Or you have, you hit the maturity wall in CRE. I know those loans are being modified. Or you hit a maturity wall in Treasury debt, which is there's a coming maturity wall there. Or you hit some kind of maturity wall where these people can't refinance, can't take advantage of the private credit, which has been doing that refinancing. And you start to get these massive defaults. When those debts get written off of the ledger of the M2 money stock, you get a smaller system, and that is sort of de facto tightening. So the thing is it could be a number of things. It could be another pandemic. That would be a catalyst. So we just have to sort of watch the news for the potential catalysts and then just see, what's gathering momentum. Are we really going to hit World War III? If oil is rising, we look at a technical chart and go, okay, historically, price-wise, where are we at? Is it blowing out? It did actually in April, I believe it was April of 2008. Oil just went through the roof. So I don't have that chart in front of me, but that's from memory. Sometimes the blonde prevails. And so these different things that can happen during these 4 seasons. And then number one, it becomes a catalyst for the business cycle, and then to start to move through its seasons. And number two, create systemic risk, which people tend to react to, and that's what causes the reaction in markets.
Yeah, I appreciate that wisdom and the shocks to the systems. It's almost like this: when we're sailing smoothly, the risk is removed, or perception of risk is removed, and at least investors have predictability. In this environment, predictability and risk are sort of not there. Well, the risk is there, but the predictability is not there. This is the most difficult component, where folks not feeling comfortable in the direction of where we're going. So let's go back to the slides. We'll go through the slides quickly, and then we'll come back to Q&A.
Beautiful.
All right, so we're here. Let's go to the next slide. Okay, so this is the interest rates. Well, it's missing the first dip down. This is the first quarter. So the first half a point that we saw in September.
Yes. Right. So this is the federal funds effective rate. I thought this screenshot was kind of in present time, but anyway, these all come from the Fed, which is the the site of the St. Louis Fed. And you're just going to get good data from there. I mean, there are lots of charts that are promulgated all over the internet, and they may or may not have great data. So what you will notice about this is you had that big spike, and that looks like it was in the, that was in the early 80s. And those gray bars are the recessions. You had that big spike in the federal funds rate, and it's been in a bear market trend, meaning lower lows and lower highs for the most part until this recent cycle. And so to go back to your predictability point, the thing that's making this a little unpredictable. Now, I was sort of in the thinking in the camp of the mechanics of like, we're always going to have lower and lower Fed funds rates because we have so much debt in the system that when you assign a percentage to a much, much, much larger pool of money, it's a larger number. And we are seeing that. We have $1 trillion, it's estimated that we owe $1 trillion in interest payments every year now on our debt in the US. And so you would say, okay, if that doesn't continue in a bear trend based on the mechanics of having more and more and more money in the supply, then you're going to have some kind of a credit situation. And what's made this cycle very unusual and harder to predict is there have been certain anomalies that have kept that credit, have compensated for having rates that high. Number one, the fiscal spending. Usually you get a default cycle when there's not enough liquidity, and I often use the swimming pool analogy. That fiscal spending has been putting so much liquidity in that swimming pool that you're not seeing that drop in liquidity to the point where it's not going to be able to service the debt in aggregate. The other thing that you're seeing is that where individual investors, corporations, commercial real estate funds, et cetera, et cetera, et cetera, would normally be defaulting because they cannot, they wouldn't meet the underwriting criteria of refinancing with these much higher rates or something like that. You have private credit coming in and charging a premium for the excess risk on that underwriting. And so because you have that, these loans aren't defaulting. And when the loans default, they come out of the system. And so you're seeing that these loans aren't coming out of the system. And so that's keeping the swimming pool and the liquidity high. And the third anomaly that you have is you have people putting things on credit cards that they ordinarily would use salary or savings. Salary or savings has already come into the system. Credit, anytime you issue credit of any kind in this fiat-based economy, you are expanding the money stock and you are filling that swimming pool and providing liquidity. So you have 60% of Americans putting groceries and necessities, on these credit cards. That's adding a lot of liquidity to the system. So you see that federal funds rate moving higher and you think, whoa, can the system handle that shock? And it's these three buffers to the system that have allowed it to absorb these higher for longer interest rates beyond probably most people's imaginations.
Yeah, I appreciate the great wisdom. And here is a follow-up question. Consumer debt is approaching, let's just call them historic levels. There's all kinds of discussions that the consumer is really tapped, and then on the less lag, and they've even talking to IRA custodians, people are tapping into their IRA savings. So the observation is the consumer is maintaining this level of spending, but the problem is at some point the credit runs out, the even self-directed or whatever the IRA savings they run out. At some point, consumer just gets overstretched to the point where it's a hard crash. And maybe that's why Fed had to cut 50 basis points, because the increase in debt is basically drains the liquidity further in the form of interest rate payments.
Right.
So what's next? Are we going to see a real contraction? Is it going to come to a hard crash, or?
Well, eventually we are going to see a real contraction, because here's the big fork in the road. But I'm going to address. So the fork in the road is that we have a continued soft landing and we have totally new mechanical implications. And we don't follow the historic relevance of these charts, or we have these mechanics that play out. So are we, you can have a car. I use car analogies because I'm married to a racing engineer. You can have your internal combustion engine, or you can have your electric car. They still use axles and wheels. I would argue that the inverted yield curve and the dynamics of debt and fiat currencies are axles and wheels. And either we have axles and wheels or we don't have axles and wheels. If we have axles and wheels, you will see these dynamics and this domino effect play out. It's just being delayed. If we aren't dealing with axles and wheels, and post-COVID has truly changed the system, then we will start to create new charts with new historical relevance. Now, do I know with 100% certainty which fork in the road we're taking? Of course I don't. There are trillions of variables in the system. I'm in we have axles and wheels until otherwise notified camp. So I don't think that these charts are irrelevant. I just think it's watching the timing and watching for the catalyst and watching for that first domino to fall over. To answer your other question, when you think about what the Fed is doing with the 50 basis points that they cut, they're looking at employment. There's another chart that we don't have for you today that shows the correlation between the re-steepening of that yield curve and unemployment going up simultaneously. Well, let's think about the common sense domino effect around unemployment. Those people that were paying those credit card bills and paying their mortgages and paying their car payments and et cetera, et cetera, et cetera, when they had jobs and they don't have savings, right? 60% of the country is it's a loose term. It's a loose number, but it's estimated to be in that area.
50% paycheck to paycheck.
Paycheck to paycheck, yeah. And that came from CNBC a while ago. And so, that kind of thing, it's like, if those people now lose their jobs, if they're relying on the paycheck, hence paycheck to paycheck, then you're going to see the default rates increasing as unemployment increases. And does it hit systemic relevance in order to knock that domino over? And then, of course, these things happen very slowly and then all at once.
Well, that's the words of the wise. Happens slowly and then all at once. It feels like almost like a critical mass problem. It's all fine, fine, fine until critical mass is reached, and boom, we just realize that savings are gone, credit card, another debt is through the roof, and then they lost their job. That's
Yeah.
it. That's the end of the consumer, right? And that's why I guess
And if you have
Fed is
that
so nervous about it.
Yeah, and if you have that happening with enough people, so the 50 basis points were coming because the labor market looked like it was softening. Now, obviously, the jobs report today surprised a bit to the upside, but you have to look at these things over a very long trend. You can't just take one number. Jay Powell says we don't take one number, et cetera, et cetera, et cetera. So, we just look for these potential catalysts, and we start looking at these charts. And you guys can go to the Fred site and look at any of these charts at any time, and you can see when they start to move. And we can go to the next slides, and I'll show you a few more things to look for.
We're going to the next slide. Okay, here we go.
So this is the M2 money stock, and you guys on your own time can Google M1, M2, and M3. I haven't totally memorized what's in all of these baskets, but this is kind of the gold standard for using, what's happening with the money supply. And you can see that this is inverse, with the exception of the recent uptick, to the Fed funds rate. And this was sort of my thesis around, you can't charge, because you have so much more money in the system, you have to charge a lower percentage on that debt in order to keep the system solvent. And so you can see that we're having a dip, and the M2 money supply is about ready to go down. But you can just see, historically speaking, even through those recessions, the M2 money supply continues to move higher. And what causes this to move higher is any new issuance of new credit into the system. Okay, Mike, go to the next one, please.
Yep.
And here we have a correlation between the M2 money supply, or the Fed has started calling it money stock, and the S&P 500. So you can see over the decades and decades that those lines, are fairly correlated. There's obviously more volatility in the stock market. And you can see, as of recently, the S&P 500 is dipping, and the M2 money supply is dipping as well. And then the stock market, with the 50 bips cut and everything, went higher again. But you can see that it's going to close that gap probably with the M2 money supply. Now, this makes sense. Why does this make sense common sense wise? Is because the stock market, particularly the S&P 500, is a liquidity meter. Because think about it, where those funds are. The funds in the stock market are the excess funds that people have available, that they're not paying their mortgage with, they're not paying their credit card bills with, they're not even in the 401ks. And you're having a lot of withdrawals from these savings accounts and things like that to cover some of this debt. But as people have less and less excess liquidity available, obviously they sell these assets to cover other debts and other things. It's going to go down. And the M2 money stock, which now we have a global easing going on, where central banks are getting easier, they're lowering rates. The Fed it's behooved the Fed to keep interest rates higher for longer to create demand in the debt markets, because we're running these big deficits, and we need to create a lot of new money and put it into circulation to cover these big deficits. And so we need, interest and demand from buyers, foreign buyers, any buyers, right? So as they lower interest rates, the demand, bond prices go up inverse to interest rates, and there's demand in the bond market that creates rates to go lower. Demand in the bond market is usually a safety play, because they usually get paid higher returns in the stock market in a healthy economy. So when they start taking away from the higher returns of the stock market and going into the debt markets where they would get lower returns, that pushes rates lower. But the point is if we push rates down to the point where people go, I'm not getting enough return, there's that sort of, chess game going on. And of course, if the Fed doesn't get enough demand, they will then probably buy the assets to fill in the liquidity to meet these deficits and stuff like that. And that's what pushes interest rates lower. So as all of this occurs,
that's the QE, right? That's whatever they
yes,
used to call a QE, and
yeah,
it's going to be an equivalent of that.
yeah. And then the question becomes, okay, great. Does that stimulate the economy? Does that reaccelerate inflation? Or do we have that domino effect of people just getting over their skis on the debt, people, institutions, corporations, whomever? And does that reach, as you say, Mike, critical mass to be systemic?
So follow-up question, again, election is very, it's coming up on us. Depending who takes the White House, how is that going to impact? I think you talked about this, but if Kamala moves from VP to the president role, we maintain substantial spending policy, and the effect is that the stock market is getting support, right? I'm just kind of reading, I'm speculating on this topic, or not, right? And if Trump takes in more austerity or more conservative thinking comes in, more balanced budget or the more balanced budget type of a thinking kicks in, are we going to force stock market to retreat effectively because of, like you said, one of the catalysts, one of the key factors that kept us afloat for so long is the fiscal policy. So if the fiscal policy start contracting, the Fed will be sort of in an urgent state that they got to cut faster, right? They got to support, they got to inject liquidity and cut faster because the fiscal policy will be contracting the pool, the liquidity pool, right?
Yeah, that's one scenario. So the way Trump is looking at this and Elon Musk is that they are going to cut taxes, and that's going to improve corporate balance sheets. And improving corporate balance sheets is going to keep the stock market elevated. Now that works if you have enough liquidity. And so that's the component that they're really going to have to examine so that they can cut fiscal spending and that there's some amelioration from the Fed in against that sort of, cutting of that liquidity. So corporate balance sheets only do well if there's enough liquidity for people to buy great corporate balance sheets. For instance, if you have to sell your stocks to pay your debts and mortgage because you lost your job, you're not going to not sell and default on all of that debt because corporate balance sheets are going to look good. Now, I don't necessarily want to make the claim that if Trump gets elected, the stock market's going to sell off. These things happen over a period of time. I honestly think that just economically speaking, investors are probably going to be pretty excited about a Trump administration just because it's more of what we understand about it. It's just the policies that Trump is going to employ are very pro-growth and pro-American, and investors are going to be excited about that. Now, on the flip side, Kamala has a different solution for the fact that 60% of Americans are living paycheck to paycheck, and that's just quintessentially to provide social assistance and other things, which keeps the spending very, very high. Now, do those people use the social assistance to get tattoo sleeves as they did during the pandemic, or do they invest that in the stock market? But again, overriding all of that is keeping the system liquid. So yes, she's going to spend a lot. That's going to keep the system liquid. And we're going to roll out with this wealth gap where the rich get richer and the poor are getting poorer until the poor getting poorer hits some kind of critical mass. That probably will keep the economy kind of humming along, and we'll be servicing the debt. And that's the whole premise behind modern monetary theory, where it just doesn't matter how much debt, doesn't matter how much money you issue, as long as you can service the debt. I would say modern monetary theory is not totally sustainable in the long term if we have axles and wheels. If we don't have axles and wheels, then I will be proven wrong, and we will just live in this alternate universe where it doesn't matter how much debt we have and how much we print and spend. In the short term, I think that markets may not necessarily, you might have a sell-off toward the end of the year, particularly in tech stocks like NVIDIA that have kind of been holding up some of the S&P 500. Because if Kamala says that she's going to, implement an unrealized gain tax, or she's going to raise taxes, and people have these massive profits and things like NVIDIA, they may be selling those toward the end of the year in order to lock in the lower tax rate. Usually tax policy is not retroactive to previous administrations or what have you, but so you may see some volatility in selling there. So there's a short-term trajectory of people being excited about Trump, people not being excited about Kamala's tax plan that could cause some volatility after the election in the markets. There's the longer-term trajectory of, yes, I'm confident that Trump and Elon can, think with growing the economy, growing production, creating revenues from, energy resources and things like that, and look at it like more like a business balance sheet. But will they be cognizant enough? And I'm not saying they won't be, but this is the key for me. Will they be cognizant enough to not reduce fiscal spending at too drastic a rate where you create a liquidity scenario? Because you have to recognize that that's what's been keeping the economy liquid. Over the longer term trajectory with Kamala, we're living in a more of a collective bargaining and government subsistence kind of thing that is creating consumer demand, et cetera. Now, is she able to keep up with that so these people can pay all of their debts and buy all of their groceries because she gives enough assistance and enough support? And then if they're not employed, how does the production, when you look at, GDP, I mean, one of the things that's kept our GDP afloat is the government spending, because that's one of the factors in GDP. And so are you going to keep GDP elevated from that rather than production? And Elon Musk in the All In podcast is like, look, we want to take them out of this operating system. And he looks at things technologically of keeping GDP elevated from, government subsistence and government spending, and go into the operating system of creating employment opportunities and production and letting that be the thing that keeps GDP buoyant. But the transition from one operating system to the next operating system is certainly dependent upon liquidity.
Yeah, that's again a lot of great wisdom, and I'm just hearing this. This is not new, right? If Kamala wins, we are dealing with U.S. government spending as a significantly larger share of GDP. That share is growing, and it'll continue to grow. If Trump wins, takes Elon Musk as the chief economic advisor, I'm not sure if he's going to take a position in the government, probably not, but at least very significant influence, then we got to try to move to a more, let's just call it, business is a driver of the economy versus the government is the driver of the GDP and overall economic welfare. So that's the good old news, right? That's the old. Now,
I really like. I'm not a political person. I do like Musk. I think he's super smart. However eccentric he may or may not be in his personal life, I'm not really that interested. The results in his life are he's running these massive, he's not running one of these massive companies. He's running many of these massive companies. And obviously he's doing something right. And he focuses on the quality of the product. And what he uses humor to explain these things, which that All In podcast with Elon Musk is fantastic for anybody who wants to listen to it. But he compares East Germany to West Germany when you talk about these political ideologies. And he talks about, West Germany producing, like, being said, they have the engineering capabilities and they produce all these luxury cars and Mercedes and Porsche and Audi, and BMW, and all of these things that these people were benefiting from this engineering. And then he talks about East Germany back in the day, and they had one car maker. I think he compares it to like some kind of cardboard box with a roof on it, if I remember correctly. And he says that there was one car maker and there was a big waiting list, and and that was sort of this other operating system. So when he juxtaposes those two operating systems with such humor but some truth, it really just goes to show you, it's like, which operating system do you want to live in?
Yeah, I'll add this to your commentary. I grew up in the former USSR. I grew up when it was the USSR. I left when it was still a USSR in '89, and my observation was very similar to the East Germany. It's pretty much, when you have a bread, you have one type of bread. You have car, you have one type of car. Okay, two type of cars. I grew up in the Soviet Union. There was the Zhiguli, and then the Volga. That's it. There's only two type of cars. You didn't have variety. With the bread, you had the white or black. And the crazy part is, there's truth to this. There's certain operating systems. Let's just call it, I don't know what do you call what, socialism, communism. It's a centrally planned economy with centrally dominated single party, and you're either part of a system or the system destroys you. That type of mentality is dangerous, and I'm political refugee from the former USSR, and I can tell you that I think that system was no good. It collapsed eventually. And on the other side, pure capitalism, it's got its own problems, but it feels to me that the more of a free enterprise lets the energy, the creativity, the talent to grow and to accomplish the same economic growth, or many ways much better economic growth and goals without the central planned economy. And there's a benefit in central planning to some degree, but it's also very dangerous if they make errors on the central planning or these big policy decisions. They could drastically hurt the economy in general.
Yeah, it's true. And capitalism definitely needs guardrails. And I recently bought an $1,100 first class ticket to on an airline, and I had 4 legs of the journey. One was from Tampa to Miami, which is the short leg, and then Miami to Colombia, and that was the longer leg. And I flew the first 3 legs. The 4th leg was canceled, $1,100 ticket, and I got an $81 refund from the airline. And you go,
how wonderful that is.
Huh?
Huh?
How did they calculate that, right? And I know it's the shorter leg, but $81 from $1,100.
And they didn't get you to where you needed to go. That's the big problem.
Well, that was the other thing. I had to buy another ticket for, another airline to get me from Miami to Tampa. So that's the thing. And so, yes, capitalism definitely needs some guardrails. But I think the thing that Elon and Trump are going to try to do is find the regulations that are necessary to protect the consumer, which is why they're there, versus the regulations that actually hinder production. And I'm sure there's no perfect answer to that, but I'm sure it can be optimized and improved.
Let's go into some Q&A. I just want to make sure we went through all your slides. Are there any more slides that we needed to cover?
There were 2 more after that.
Oh, there's 2 more. Let's go to the slides quickly, and then we'll go through Q&A. I just want to make sure we stay on target from the time perspective. So here is another Fred chart. Can you explain what we're seeing here?
Yeah, so these are the corporate credit spreads, and then there's the high yield spread and the emerging markets corporate spread. So these are the things that when you see that domino effect starting to happen, or you start to see risk in the credit market. So this is the last year, and you can see along the various quality of credit that these things are not spiking just yet. Now, flip to the next slide, because that's the last 5 years. That's what happened during COVID. So you can see that when you have a ton of risk in the system, that these credit spreads blow out. And that's what creates these domino effects. And then once the dominoes are tipped off, then it depends on the intervention from either Congress and the president, more likely the Fed, and central banks, as to how they manage if these remain elevated or not elevated. But you can go through and see, you've got AAA corporate, AA corporate, triple B corporate, high yield, that one definitely will spike. That's the purple line. High yield, that's a good, that's an indicator of additional risk in the system. And then, you have emerging markets, and that's kind of how it, with the corporate plus option, the corporate plus index, and then that shows you kind of globally the reaction, and you can see that they trade fairly well in tandem to each other. So those are the things. You can go to the Fred and you can watch the yield curve and see the re-steepening. You can go and look at the M2 money stock and see if it's rising or falling. You can take the historical correlation between that and the S&P 500. You can juxtapose any of that to the unemployment numbers, and then you can go look at credit spreads. You could track credit spreads every day, and I tell you, it happens slowly, and then all at once you will see an extreme spike, and then you'll know based on how much of a spike there is, how much risk is being priced into the system, and then how systemic it is, and then you just watch for the policy response, and that's kind of how you look at these things.
So the last graph, what I showed, if I'm reading it correctly, the risk perception is low. The credit spreads have come down. Obviously, right after COVID, we saw a massive spike, and then things have been a little volatile, but now looks like complacency. In other words, folks are feeling we're not about to have crisis. We're not about to have severe recession. We're not about to have anything bad. So it's complacency. So
yes.
Let's switch into Q&A. So
Sure, sure.
again, we're dealing with a sort of complacent market right before the election. Maybe it's quiet before the storm. Again, everything is normal until some blows up, and and usually it's almost like this. At least this is my observation. When there's low risk perception, high complacency, we're just kind of moving along little by little into climbing slowly but quietly until something really severe happens, and then we're going to be dealing with a lot of volatility and uncertainty. But let's switch to real estate conversation. So let's go with well, first question. Real estate, especially commercial real estate, heavily depends on the interest rates. So there's long-term correlation between interest rates and cap rates, although in the short term there's volatility, there's a lag effect, etc. So talking about commercial real estate, the Fed cut rates by 50 basis points. How likely are we going to see more 50s? This is an interesting an important question. Are we likely to see another 50? What would trigger another 50 basis points? It would certainly be super welcome news for commercial real estate, but what would trigger Fed to act and to cut another 50 basis points either in November or December?
Yeah, if I recall correctly, he gave a speech at the NABE, and he said he was thinking with 50 basis points, another 50 basis points for the rest of the year. Anyway, that's what's essentially being priced in the last time I looked at the futures. We have a couple of things. Anyway, we had
only a couple.
Only a couple, right? We're looking at the employment data, right? We're looking at all of that. So that's going to get factored in. Now, we have had commodity prices, and you can look at the CRB index going up, and it's been up, and that transmutes into the inflation numbers and on a lagging effect. And so you do have a little bit of risk. You see that growth and inflation are coming down, and it looks like the nowcaster type people are seeing that this is happening, but you could see a little risk of inflation reticking up on the lags of these oil prices moving higher because of the geopolitical, and just generally speaking that these commodity prices are moving up. So he's going to be looking at that. If he sees any reacceleration in inflation whatsoever, then he's going to not want to do 50 bips. And what's interesting is the employment data this morning was strong, and if he sees him, he can use that as part of the thesis if the inflation ticks back up or starts slowing at a slower rate, and just say, oh well, we've got great employment, so we've re-looked at this from the time that I said that we could cut another 50, and now we think it's not appropriate because of the employment data and the inflation data. So you could see some risk in that. Yes, obviously on the lag, this benefits commercial real estate and real estate in general. And it's kind of a wait and see approach, but I think his idea was to cut another 50 basis points going into the end of the year. And globally, that seems to be what's occurring. The accommodation in cutting rates is looking a little on the same orders of magnitude as they did during the global financial crisis. So what that tells me is they're not waiting for the global financial crisis to occur in order to give this accommodation. They're trying to stave off the global financial crisis type thing by doing it in advance. The risk of that, of course, is the reacceleration in inflation because you don't have the defaults taking money out of the system. And this is really mechanical. So I can't say for sure at this time. I think he might preemptively cut 50 given the over leveraged situation, but we will just have to wait and see.
So hearing you, and by the way, I watched that speech. I in arrears after the
did
speech.
I remember? Kind of did I recall it correctly? Yeah.
Yes, you said exactly that. He's kind of funny. He is so transparent about what he's gonna do. Versus Alan Greenspan conundrum, you couldn't understand half the words of what he said, and then you couldn't understand what he's gonna do. But here it's pretty clear that, at least to me, and what I heard you is an affirmation that at least a couple of quarter rate cuts is the minimum he's going to do. I'm going to say this again. This is the minimum he's going to do if inflation appears to be a little too hot, if employment data is too hot, but he's still baking in at least 2 quarterly cuts, and he may do a 50 cut in between if something soft, really soft comes in.
Yeah.
Am I hearing this correctly? He said that
Yeah.
the base case pretty clear. He's gonna cut no matter what. It's just the speed of the cuts is what we don't know.
Yeah, I mean, he didn't start we remember the end of 2018, and he didn't start cutting, and then until the stock market sold off into Christmas. I believe that was 2018. And then then they came around and they were still reducing the balance sheet well into 19. And then you had not enough liquidity in the system. You had those corporate tax payments coming through, and you had that crisis in the overnight markets, and interest rates skyrocketed, and he had to come in, and I think it was
repo market crisis, right? That was
the repo market crisis. Yeah. And he had to come in and inject an enormous amount of liquidity before COVID. So he remembers that, and he's going to try to not have that happen this time around. And I think that's why he's being more preemptive than he was when he was, brand new in office. I'm not saying being preemptive is good, bad, right, or wrong. He's obviously not waiting for the crisis to hit before he starts being more accommodative. And that's what I heard. I heard this is the base case. So he does realize that there is some weakness out there. We are super over levered. And so we just have to wait and see what this plays out. But I think the narrative that he gave, like you said, he doesn't want to cause excess volatility. So he's trying to be very transparent. He's one of the most disciplined communicators I've ever seen. And I don't think that he should cause excess. I mean, people are always screaming, like, why doesn't he say what he really sees and this and that? And they're publishing all these things. He doesn't want to, them saying that doesn't create volatility. Him saying that is a whole different responsibility level of creating volatility, because we hang on their every words. And I think he's also communicating that as the Fed, we've got your back. If we need to, we'll cut here. If we see something soft over here, we'll cut here. Minimally, we're cutting. I've got your back. I've got the back of the economy. I've got the back of the markets. And so he seems to be, saying that the Fed put is well in place so that people don't have to speculate about that.
Yeah, I appreciate that. I remember we were at the dinner months ago in the Miami area. You came to dinner and you gave a little bit of a talk. And I think one of the things you said, he's not in a preventive medicine. He's an emergency room medicine with some exceptions. Yeah. But here he's starting a little bit of preventing work to avoid the emergency room massive, the patient is about to kick it, and you gotta do something big. But
so I had this debate, right? Like, do you wait for the crisis? Do you not wait for the crisis? The only benefit of waiting for the crisis is you find out where the neutral rate really is. And you have more data. And then with that more data, you can give a more precise handling. Preemptive, you don't really know where that neutral rate, it leaves it more nebulous.
Around 2.9, right? He stated that they are going towards 2.9.
It's an estimate, but yes, but when a credit event happens, then you immediately know when has that water level in the swimming pool, violated that level where it's unsustainable. If you preemptively do this, you don't really know where that level is. And so anyway, 6 1/2 dozen the other.
Commercial real estate. Let's switch a couple of conversations, and specifically sort of private credit. And there's been a lot of discussions on a lot of participation in today's environment through preferred equity, mezzanine debt, recovery capital, preferred equity, sort of on many deals. What do you think about sort of the market direction, again, with that setting the baseline, where we're going to keep going down towards neutral rate at at least baseline pace, right? What he said, with possibility of acceleration in case something really breaks, and investments in commercial real estate. I know you're not giving investment advice, just more of a high level discussion. Does preferred equity, mezzanine debt look like an interesting opportunity today to start participating in the market without perfect clarity and perfect predictability, but just more of it feels like it's a lower risk play relative than the equity play, but beginning to take advantage of where the market is going. And it's a directionally lower move. Just you got to figure out a way, how do you participate? How do you start making money and deploying capital conservatively, in a manner of speaking?
Yeah, so basically when you look at what what problem is preferred equity solving? What problem is mezzanine debt solving? They're solving the problem of, number one, trying to stave off a liquidation by injecting new funds. But number two, they're solving the problem. We're assuming more risk, right, in those products being attractive and available. And they're solving the problem. Okay, if we liquidate, where are we in the capital stack? When do we get paid? That's part of what's being offered. And that would denote more risk, because why would you care where you are in the capital stack if the risk wasn't rising that your project's going to fall apart? And when you have the swimming pool violate that liquidity level, or I also like to use the analogy of musical chairs, when the music stops, somebody's left without a chair. And so I would say this is a way to make money because you are getting paid for the risk that you're taking. However, it is so important that you have a very solid underwriting process, because private credit is looking a little bubbly. And when things look a little bubbly and the water in the swimming pool drops, what private credit project is not well underwritten and at more risk for liquidation or failing? And then where are you in that capital stack? So those are the things. If you have, excellent underwriting, then yeah, you can get paid for taking on more risk. And then of course you're taking on hopefully a responsible, you're deploying a responsible amount of funds for your own personal situation, which you should analyze with your financial advisor. And that's what's happening. But the attractiveness of preferred equity and the attractiveness of mezzanine debt is attractive because there's more risk of default in the system. And otherwise those things wouldn't be attractive. And so, obviously these projects need funding. If they didn't need funding so badly, there wouldn't be any reason for them to pay the higher premium that compensates for the risk. And so that all of that being attractive and being put into the equation is saying that there's more risk in the system and you're compensating for that. But I would just say, if you want to participate in that, just talk to your financial advisor and just make sure that these deals are super well underwritten and that you're comfortable with the underwriting of these deals, so that you can get that yield without, having to wait in line if something liquidates.
Yeah, that's a great wisdom. Underwriting is critical. Underwriting was a big concern a few years ago when everything was rosy, and a lot of underwriting assumptions for equity were just too aggressive, and things didn't pan out for many reasons. And today it's the same concern, but no longer equity. Equity play feels ultra aggressive, while the preferred equity or mezz debt is substantially better than the common equity. At the same time, very prudent underwriting based on current market conditions is what you're saying is critical.
Prudent. Yeah.
But what are the changes in interest rates likely going to do to this? So as rates continue to slide down with Fed forward guidance, at least in a base case scenario, are we likely going to see meaningful improvements in valuations of commercial real estate? How long would it take? People have asked the question. I know it's a crystal ball question. When are we going to see recovery? How fast is this recovery? How big is this recovery? We do know we're going towards, let's just say, approximately 2.9% target. But it's a measured pace, year and a half. And we all would love to see improving valuations, but how soon? Is there any kind of, what's the right perspective?
I will leave you with this wisdom. And you've been so kind to call the things that I'm saying wisdom. But look, it depends. Okay, so when you look at our rates, okay, first, our rates going to come down in the premiums that you're getting in the mezz debt, the preferred equity, and all of that stuff. Now, risk will go down as valuations increase, but valuations increase, you have to have demand. And so you're going to be looking for the demand, and you're only going to have the demand in a soft market, soft landing type environment. If you have a hard landing, that demand is going to go away temporarily. And so the demand is also going to affect the valuations. The other thing is that it's the same token for the demand for debt, right? Like Fed's lowering interest rates. Are you going to be able to command a lot less, filling in financing with these mezz debt deals? Well, it depends on the demand. How desperate are these projects for liquidity? Because that's what they're going to end up paying in interest rates. And as is that premium going to be baked in because they're desperate for funds, or is that premium no longer going to be baked in because it's going to track more with, the treasuries that are going down, and the prime rate that goes down, and whatever the interest rate is tracking. So I would just say that valuations will improve if we have a soft landing. I do expect the soft landing would be that the Fed preempts any possible credit scenarios and provides enough liquidity well in advance without reaccelerating inflation. Because the thing is if inflation reaccelerates, he's going to have to turn right around and do the other thing. He's got limited tools. So your pricing mechanism is supply and demand, both for equity, but also for debt, and the dynamics behind that alongside the juxtaposition of the lowering of rates and the lags that go there. So if he's able to lower rates without having systemic disruption, then yes, on a lag, valuation should improve.
So if I'm hearing you correctly, the soft landing scenario is avoidance of severe recession, avoidance of serious spike in unemployment, while he's gradually lowering the rates, and at the same time not respiking the inflation because he's taken the foot off the pedal too much too fast. It's a very delicate balance. Oh, but
and
lending is
it
an ideal
depends on
scenario.
who gets into office. It depends on who gets into office. I mean, like you said, if Trump gets into office and they cut that fiscal drastically, obviously Congress has to be involved, right? So it's is Congress, is it a split House and Senate as far as Democrats and Republicans, or do the Republicans or the Democrats win the day? And that's going to be a determining factor. And I've heard some investors say less volatility if it's split, because there will be less drastic changes to the system, whichever direction you're headed in, left or right. Sorry, Mike, say your question again.
No, I think you answered the question really well. And then what happens? Let's just hypothesize a little bit more, and we will kind of wrap up and open the floor to a few more questions.
Sure.
What happens if we actually start seeing a recession? Meaning that somehow, there's a possibility of critical mass problem, like suddenly something starts breaking we're very, very hard, and then that's the urgent response scenario. What we start seeing meaningful softening in data, where it looks like we are going into real recession, and then how badly does it affect aggregate demand, and how badly does Fed have to respond? Or this is all just so fluid, we can only speculate in the subject, we don't even know. And a lot of things
it depends on how systemic it is, right? So if you have the unemployment rate rising, how systemic is that? How many people are losing their jobs, and how many of those people then can't pay their credit card bills, or their mortgages, or their house loans, or car loans, or what have you? So it depends on who's in office. He's going to have to dance around who's in office and what is their response to a massive recession. Is it more fiscal spending? Is it government assistance? Is it we're going to try to grow out of this? Well, if we're going to try to grow out of this, that's going to take a lag. Changing those operating systems is going to be a lag. So then the Fed would be, sort of filling in where the fiscal's coming out, the monetary then comes in, where right now the fiscal's the driver, and so the monetary is taking money out of the system. So, he's just flipped on interest rates, but we're going to have to watch what the balance sheet dynamics are, what the demand in the debt markets are. So it's not a super easy answer. But I do think that, what Powell has communicated is whatever occurs in the markets, and implied whatever occurs with the election, implied whatever occurs in the debt markets, credit markets, et cetera, that he's there and he's willing to do whatever he can with his tools in order to compensate for that. And so we will just have to kind of watch, and his compensation is going to be different if you've got one person in office versus the other person. And he knows that. He's not saying it, but he knows that, because the fiscal implications might be similar, but in the short term, if we have a recession, there might be a lot more fiscal assistance before you can switch operating bases. But in the longer term, if Trump gets into office, I think you're going to see a switching of that operating basis. And hopefully you don't see austerity in the US like you're seeing right now in Argentina, which that's also a systemic overhaul. But they have some austerity measures going on. I think that mechanically it can be done without austerity. That's a pretty radical thing to say. And another time, another place, it's a long conversation. I would explain how I think that that's possible mathematically, but it's not an obvious solution for sure. It's very outside of the box.
Yeah, I appreciate the wisdom. I guess it's a lot of it's back to the argument: who's more powerful, or who's more important, who is the wiser president of the Fed or president of the United States? Because it sounds to me the Fed, at least that's what I observed, they had to clean up the mess that the politicians make. I don't know how else to put it. Politicians create a problem, and then the Fed winds up cleaning it up. That's what it feels like, right? Their monetary policy responds
Absolutely.
to fiscal policy, and then they wind up trying to deal with inflation or trying to deal with austerity or whatever is created by the politicians, right?
Well, there's some truth to that. And who's more powerful? Well, the Fed is not as reliant on Congress as the president is. So there's that factor. It's funny because there's been some news that Donald Trump has a new plan for executive orders regarding the Federal Reserve and interest rates, which would obviously be a massive change to the system. And that would return the power back to the president that the Fed currently only has because they're authorized by Congress, by the way. It's really Congress that's authorized them with this power. But yeah, more powerful. The Fed has less friction to work through on the decision making than the president does in the current reality. And that's just because obviously you can do executive orders, but when it comes to a lot of spending and things like that, you have to engage Congress.
Okay, that's a lot of wisdom. Quickly, let's open the floor to some questions. I don't know, maybe Yuri G, you could see some questions. I have a few pre-submitted questions. I'll try to bring them up. We are a little bit past the time, but we'll give it another 5-10 minutes. Hopefully, Frances, you're good with this.
Yeah.
And then if folks have great questions, please type them in. For some reason, I am not seeing any questions, so we'll give folks an opportunity. And I'll just bring a couple more questions from the pre-submitted questions. And do you see interest rates eventually going down below 3%? This is kind of as basic as it gets, at least on the Fed funds rate policy.
Yeah, if we have a crisis, because rates will drop significantly if we have a crisis. If we don't have a crisis, I still think it's possible. If we have easing compensating and we have rates around the world moving lower in order to sort of preempt the crisis, yeah, I do think it is possible, and we have more money and more debt in the system. And then it's just about, it's a matter of paying the interest on the debt, etc. I do think that there is some, I do think it's possible. Nothing's guaranteed. I do think it's possible.
Yeah. I guess this question was prudent. This is not a ZERP. This is not zero interest rate policy, just going down to 3%, see what happens. And your point, this is a very powerful point, that we actually have to sell our bonds. Buyers have to buy, foreign buyers, whoever. If we don't have enough demand there, then it's all Fed monetizing, it's all form of a QE. And do we want to go ever to the place where we're buying so much of our own debt to keep the rates down? And that's a fundamental question. Japan somehow has massive national debt as a function of GDP. The debt to GDP ratio is very, very large, and they were in negative interest rates for many, many years. I don't know. Is that a possibility in the US at all?
I really thought so. I was looking at that Fed funds graph and I was like, okay, it's going to have to continue to have that bear market structure. And because based on the amount of debt in the system. So I really, years ago, I was like, we're eventually going to get there. And, right now I will just say, I don't really know. I'm curious to see if they can accomplish a quote unquote softish landing by accommodating ahead of the credit crisis instead of waiting for the credit crisis to occur. But yeah, eventually, the problem with the United States and other places, I think maybe we didn't have to go to, I'm just speculating here, but I think maybe we didn't have to go to negative interest rates because of the world's reserve currency component. So as long as we're able to keep that and keep the BRICS from getting critical mass to where enough countries join them, that they then start to have a global conversation about the US dollar and the strength of the United States balance sheet. I think Elon and Trump are very aware of that risk. I haven't heard the other administration talk about it so much, but I'm sure they are very aware. And so it's about keeping the relevance of the US dollar is very important.
Yeah, understood and agree. If we lose the reserve status, US becomes third world country. God forbid. I mean, we've seen
God
the Ray
forbid.
Dalio talks about these cycles, and eventually all the the great powers come to some kind of a peak, and then they come down. But how long it'll take, who knows? Another question, sort of almost a final question. What are the best investment ideas in this environment? Some high uncertainty, some, again, without advice, just kind of ideas. What should folks think about in this environment? And at least I want to start sort of one of the basic observations, and I'm going to use it recency bias, and then maybe you can continue the thought process. So recency bias, where we just saw a peak of the market, and a lot of equity investments, at least in commercial real estate, have retreated from because of our higher for longer interest rates. The market shifted drastically, fast and furious, and now we find ourselves not fundamental problems other than like office and a few other things that were broken by COVID, but we find ourselves with the sort of a financial structure driven valuation adjustments on equity. So a lot of folks who have participated in equity in the last few years, they're feeling pain because valuations corrected. The investments from a few years ago, some are completely malfunctioning, some are partially malfunctioning, and there's also a lot of uncertainty where things will play out. So folks are sitting on sidelines, hoarding cash, trying to avoid more risk. Is this still the right way to think, or is this really the right opportunity to actually consider putting fresh capital to work, but do it much more conservatively and carefully? Because investing aggressively in this environment feels wrong, and a lot of people just feel from recency bias they don't want to even consider doing that.
Yeah. Very tough question to answer because
Risk aversion,
it all depends on your personal situation. It all depends on your liquidity needs. It all depends on whether we have a reacceleration of inflation. I mean, I saw somebody made a calculation that the US, your cash lost 25% over this iteration of inflation because your purchasing power went down. You need to have, generally speaking, general educational advice, not advisory. You just need to have, I would have a year's worth of emergency funds so that you can keep your lifestyle, very liquid and available, period. Beyond that, whether you want to invest in various sectors that tend to do well in, a sort of stagflationary or potentially disinflationary environment where you have either growth softening and inflation moving up a little bit or getting very sticky, or you have growth and inflation decelerating at the simultaneous time. There are certain sectors that perform well under those circumstances. I'm just loath to say, because of my compliance and everything with my firm, I'm loath to say, what those really are. You can call me and I can have a discussion with you, or you can call Mike and have a discussion with Mike. As far as deploying more assets into private type stuff with liquidity issues, you just have to make sure that you have enough liquidity available, because what's happening is people are over allocated in some of these private markets because they thought that they would either distribute, or they thought that those valuations would remain attractive. And because the valuations have come down, then, it disincentivizes a transaction. And so you just have a bunch of locked up money. And so people who have, millions of dollars in investments have these liquidity issues. That's what we're seeing. So when you think about deploying capital in this sort of uncertain, higher risk, et cetera, environment, you have to, I would say, first and foremost, consider your liquidity.
Yeah, those are the words of the wise. We've seen this and heard this in the private credit and private equity space in real estate, commercial real estate, drastic fall in the transaction volume. As a result, liquidity is very low, and normally liquid funds just cannot redeem people. And this is the norm today. So folks absolutely need to consider. I think liquidity is a critical consideration. Probably liquidity decisions are more important than the ROI decisions and risk reward. If you can't sustain liquidity shortage, then you can the future return doesn't really matter. You got to pay the bills today. So that's a great wisdom from you.
If you file bankruptcy, but then you get a few $1,000,000 years later, it's not a good scenario for anybody.
Yeah, what do they say? People die from or companies file for bankruptcy from liquidity problems a lot more likely than from a balance sheet problem and their future assets and future
or lower ROI or more conservative underwriting. Yeah.
So and this is, by the way, on the individual level, and then also on the U.S. countrywide level. That's why liquidity is watched so carefully, and that's why it's Fed's job to make sure that we have enough liquidity. If liquidity starts drying up, bigger problems start happening.
It's the lifeblood of the personal household. It's the lifeblood of a corporation. It's the lifeblood of the economy in general. If you don't have enough of that, you just don't have enough blood circulating around. So I think I would just leave folks with that. And anyway, it's been such a pleasure to be with you today. And I hope that this has shed some light on some things and people have some new things that they can watch, some new headlines they can watch. And then, Mike will send up follow-up information about how to contact him or how to contact me if you have any further questions. I know we didn't get to too much Q&A today, but hopefully everybody found this super valuable. And